We've got a heavy focus on Social Security on this week's program. We're joined by one of our certified financial fiduciaries at Nelson Financial Planning, Rob Field, who is a national Social Security advisor. And we're going to be talking in our main three segments after this opening segment about all things Social Security related. So make sure you got a pen and paper handy to maybe jot down a few notes. We're going to be talking about, does it make sense to take it early? Does it make sense to wait? What's the history? Is it still going to be around? All those kinds of things coming up here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary, where our team of certified financial fiduciaries at Nelson Financial Planning stands ready this week to help you change your life with a successful and cost-effective retirement plan. So one of the things that we hear an awful lot about these days is the notion of companies like Robinhood, or maybe folks using the trading platform of Robinhood. And it seems like that's all that anybody is talking about. As a matter of fact, when we were on the Best of Central Florida television show on CBS last Sunday, where we were awarded the People's Choice Award, so a very nice honor that we certainly thank our audience for. The reality is that that was actually one of the questions that came up even in that show, was about Robinhood and why so many people are doing Robinhood, and what, why is that so important, or getting everybody's attention. And so it struck me with all of the conversation and all of the talk about individual stocks like AMC or Robinhood or GameStop or any of those types of companies that seem to really be dominating the press. How much is the world looking at that and saying, I'm going to do that, or I'm going to start to do that? We've got some interesting statistics that we wanted to share with you in this first segment of the program that may put, or at least it put my fears at ease, that the investing public wasn't completely losing its mind. Because here's the reality of it. There was actually a study done out of University of California, Davis, and it measured the activity of speculative day traders over a 15-year period of time. And the results at the end of the day were more disastrous than I thought they might actually be. What the study found is, of these frequent traders, less than 1% came out ahead after expenses. So that basically means that 1% out of 100, so 1 out of 100, actually managed to get a return that was sufficient enough that on a net basis after expenses to actually be positive. That's saying the other 99% clearly lost money. Not only did they lose money, they lost a lot of money when you start to take into account the expenses of trading on a regular basis. What's even sadder about that statistic is that if you look at the markets over the course of that same 15-year period of time, average annual return was about 8%. So if you need another piece of evidence, or another study, or another statistic out there about the importance of being consistent with your investments, there it is. And what all of this conversation in the media about GameStop or Robinhood or any of that stuff does is it makes us feel like, hey, are we missing out on something? Should we be doing something different? And the good news is that it really does seem, when you look at the data, that people are kind of ignoring that, which I think is a great thing to see, that investors are kind of turning a deaf ear to that. Because if you look at another study that was done on the 4.7 million Vanguard accounts, and this was a study that was done internally at Vanguard, Obviously, Vanguard, one of the largest institutional money managers in the world, 4.7 million accounts. And what it found was that 15 years ago, or maybe 16 years ago, back in 2004, the amount of trading that they would typically see in those accounts was that about 20% of those accounts would be trading on a regular basis. Fast forward to the year 2019, and that number had gone down all the way to 7%. So that really is, I think, actually a positive trend, that folks aren't getting sucked into all of this conversation about day trading and trying to buy these companies that are going up 1,000% overnight and those kinds of things. Now in 2020, as you might well imagine, in the middle of a pandemic, you did see that trading number go up from that 7% of all accounts to about 10% of all accounts. So a little bit of an uptick, and that makes sense considering the pandemic. But here's even the more interesting statistic, which goes sort of hand in hand with that UC Davis study about how the frequent traders, only 1% managed to even break even after expenses. Meanwhile, the group that sort of buy and hold, stays consistent, stays steady, did actually quite well. This analysis of these Vanguard accounts, average account balance rose about 20% in 2020, so that's obviously a good number. And then since 2011, those accounts up about 65%. So again, it's all about being consistent. It's all about not getting too distracted by what you see in the mainstream media or on social media, because my goodness, if you open up your Facebook or your Instagram or whatever, it seems like everybody is out there talking about the GameStop or the company that they wound up buying and making a bunch of money on. Be careful. Looks can and are in fact deceiving, especially when it comes to talking about investing in individual companies. But certainly everybody's talking about it. It was one of the questions that I fielded on the Best of Central Florida television show this past Sunday, that aired this past Sunday. So anyway, don't believe the hype. Not getting any return for those people that are doing it on a regular basis. And the other part of it is that I think the message is actually, when you look at the data, seems to resonate in that not many people are doing it. In fact, a couple of comments or words of caution. 54% of the balances in those Vanguard accounts all were in target date funds. You know our opinion on that. If you don't, just go back into our podcast library or our YouTube channel. We think that those are very cookie cutter options. Better than nothing, absolutely, but not nearly as finely tuned as you could be. And then number two, and this is also very important, the data did not take into account accounts that had automatic rebalancing. And we think that's a good idea. Maybe not doing that every quarter, but certainly looking at your accounts every year or two and looking at making sure that your balance is still where it needs to be, because the reality is that over time, things are going to do better than others, and that's going to cause your account mix to drift out of balance from what you originally wanted to achieve your financial results. So some interesting stats on day trading and on high frequency trading and on GameStop and Robinhood and all that stuff. Really good news there is that not many people are doing it. Thankfully so, because the return is not very good. We're going to take a break. When we come back, we're going to start our conversation about Social Security. So stay with us here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Social Security. It is a major part of everybody's retirement. And so we're going to talk a lot about it on the rest of the program. We're joined by an expert that we have the fortunate opportunity to be with us as part of the team at Nelson Financial Planning. Rob Field is a certified financial fiduciary, as is everybody on the team at Nelson Financial Planning, but he also happens to be a national Social Security advisor. Rob, welcome to the program. We're glad you're here.
It's good to be here. Thanks for having me on.
Well, good stuff indeed. So tell us a little bit about your background. Obviously, this is the first time you're on the show, so let the listeners in a little bit on who you are and what's your background.
Sure. That is correct. I'm a long-time listener, but first-time guest. Early in my career, I was with E.F. Hutton as an investment broker, and spent some years there learning and kind of honing my craft. Fell in love with mutual funds very early into my career, and so spent some time with a couple different companies as an internal wholesaler, later on an external wholesaler. Moved back into the financial planning side, and then I joined Nelson Financial Planning about 6 years ago.
Very good, excellent. Yeah, E.F. Hutton, boy, who you got to be a certain age to remember those ads. But when E.F. Hutton speaks,
people listen.
There you go. So that's a fun history lesson, I guess, or maybe not so for many of our listeners out there. So tell us a little bit about Social Security. I mean, obviously, we all know it's out there. We all know that we're feeding into it. If you're working, you're paying into it. Tell us a little bit about the history and sort of where it all came from.
Sure. So in 1935, the government decided to come out with Social Security. And they were basically thinking this is a way to maybe supplement other retirement that people had. Came into place, 1937, they started making their first payments. In 1937 through 1940, they actually just did lump sums.
Oh, okay.
So they were not doing it monthly.
Wow.
Going into 1940, they started paying out monthly. A lady by the name of Ida May up in New York received the first payment of $22 per month. She lived to be age 100, so she benefited quite well from it.
The very first recipient blew the entire economics
That's right.
of the plan.
Actuaries had to immediately adjust the tables.
And it's been going down. It's been getting in financial trouble ever since.
Correct. And so moving on from there, the first time they did a cost of living adjustment was around 1950. By 1972, they were doing it on an annual basis, and then we still see them today. Back in 1937, the average life expectancy was about 60 years, so not that many people were collecting much in Social Security. We fast forward today, life expectancy is above age 80.
Right.
First, in 1937, that year they paid out about 1.7 million in benefits, and last year we paid almost 1 trillion,
Wow.
900 plus
Wow.
billion.
Wow.
At that point, again, Social Security originally was let's kind of supplement what people were doing with other retirement. Today, 1 out of 2 retirees, Social Security makes up 50%
Wow.
of their income, and 1 out of 4 retirees actually, Social Security makes up 90% of their income.
And the reality is, when you look at what that program was originally established for, it was meant to be a safety net to supplement pensions and savings and things like that. And those are just some unbelievable statistics about how many people rely on it solely. So I guess that gets us into the conversation right straight out of the gate about financial condition, right? We hear a lot about it. Where are we on all of that stuff?
All right, so out the years, they've paid Social Security. It's hung in there quite well. We're actually Social Security is sitting on about 3 trillion of reserves, and that number has been slowly growing. The last few years, amount of money they've paid out versus amount of money they're bringing in has kind of shrunk. And this year, it's possible they could pay out a little bit more than what they bring in, but it's just a couple of billion, which I know that's a lot of money, but
Billion here, a billion there,
right.
That up.
But a couple of billion to the 3 trillion is a very small percentage. Concern, and again with COVID, we had some people retiring early instead of going back to work, so that increased the number of people applying for Social Security. And then we also have with unemployment, that's less people who are paying in,
Right.
And basically Social Security that the seniors who are on Social Security now are receiving is some of that's being funded by the taxation on current owners, people who are earning.
Well, and so when we look at the finances, one of the biggest concerns that everybody has out there is it going to be around? I think it might should be around for us, but what about someone in their 20s or 30s? I mean, what's the prognosis for them? I guess.
I think it looks good. Social Security is always constantly looking for ways to improve the system so that they either can get more money coming in or guarantee money going out. Every year they will increase the amount of wages that are taxed. Last year they would tax wages on the employee level 6.2%. Employer kicked in another 6.2%. They were taxing it up to about $137,000. This year in 2021, they're now taxing up to $142,800. So that's a 3 to almost 4% increase in the amount of wages they're taxing, and that's the number one source for funding Social Security is the taxation of wages.
Right.
Over the last 6 years, we have moved the kind of the bar from what would be full retirement age of 66 is now 67.
Right.
So that number comes into play because when you retire, full retirement age is one number. If you decide to retire early, you're going to get less.
Mm-hmm.
If you wait a little while, you'll get more. So Social Security would love to nudge people or encourage them to wait a little longer,
Sure.
so that the sources would be there. But they will continue to increase the way that they are taxing wages. It was only about 60,000 that was taxed in the 90s, and so we've dramatically increased it.
Sure.
And they'll try to do incentives to get people to wait longer to retire. I think at some point you'll see full retirement age go up, that age 70 number maybe be more enticing. If you decide to go 62, maybe make the minimum become 64. These are just things that are being floated around that could help.
Well, and certainly we've seen those, right? The increasing age, I saw that. And full retirement age was 65, now it's 67. The increasing of the wage amount, the amount of wages that applies to the Social Security tax and the Social Security tax itself. Right now, it's 6.2% on the employee side, 6.2% on the employer side for a combination of that 12.4%. But ultimately, if you sort of look at that taxation rate over the course of the past 50 odd years, it's certainly been on a steady incline. And then we have some of the proposals that are coming out of Washington today that would really sort of take a much bigger step, I guess, in that direction, particularly with some of the proposals that are currently in Washington.
Correct. Biden has put a proposal out that he would like to see 400,000, up to 400,000 of income be taxed. And that's a dramatic increase, right. And there are plenty of people out there earning that rate, so that would fund Social Security on a much stronger basis. His proposal also wants to beef up Social Security offices as far as number of staff, improve the website.
Well, that would certainly be helpful, because I know a lot of folks over the years have certainly shared struggles with trying to get in touch with Social Security to get their questions answered or to get changes. So that proposal at that 400,000, it basically would create sort of like almost like a little bit of a donut hole where above the 142.8 number to the 400,000, you wouldn't necessarily be on the hook for more Social Security. But then once you're above the 400,000, then you would be on the hook for the full 12.4%, or the employer each paying their half. So that could potentially generate some additional revenue, while at the same time not necessarily impacting the masses, if you will.
Correct. If you can find a way for higher earners to pitch in more without affecting the lower earners, that's always going to be a proposal that people would approve.
Correct. Well, and we're still a vote by majority, so these politicians know that very well, and so only hitting a small percentage of the population, that's a good way to stay politically in power, I guess. So anyway, we're going to slide to a break. When we get back from the break, we're going to continue the conversation with Rob Field, our local national Social Security advisor on the team at Nelson Financial Planning. We're going to talk about some of the regular changes that happen each year, along with the difference of Social Security versus a pension. Coming up next here on Dollars and Cents with Joel Garris. Welcome back to the program, ladies and gentlemen. Dollars and Cents. All right. Okay. Sorry. I'm ready to rock. I'm trying to keep you on time. Welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We've got a program today that if you think you're going to retire at some point in your life, you probably want to be listening to, because it's a conversation about Social Security. We're pleased to be joined by one of our fellow certified financial fiduciaries at Nelson Financial Planning. Rob Field also happens to be an expert in Social Security. He's a national Social Security advisor. Talked a little bit about sort of setting the table in the last segment, the history, some of the current financial conditions. Let's talk now about some of the sort of regular changes that we see in Social Security. And then we also want to then talk about sort of what's the difference between a pension versus Social Security. So one of the changes that happens every year, of course, of Social Security is the cost of living adjustment.
Correct. There have been a couple of years in which it did not increase.
2016 being the last one.
Correct.
Yeah.
But for 2021, it did increase 1.3%. You know, its goal is to try to keep up with inflation. So every year that will be addressed. This year they moved it up 1.3. I read a couple articles in the last week. They're estimating it could go up over 5%.
Wow.
For going into 2022. Typically in October of the prior year, they will announce what it's going to be.
Right.
I saw a number of 5.3 that a lot of groups back up. So
Wow.
I think
Wow.
we'll see that. But yeah, every year they'll adjust it. Again, once a senior starts collecting Social Security, it kind of locks in a number.
Right.
So in order to keep that number, helping them out through retirement, as CPI goes up, then Social Security will try to track that and say we need to increase the amount that we're paying to our seniors.
Well, and certainly I know they wait for the third quarter inflation data to come out before they make that decision. So we won't have a kind of a final number on that. But if that is close to that number at 5.3, when was the last time it came anywhere near close to that? I mean, that's a pretty...
Back in the 80s when interest rates were
Well,
so high,
right.
we saw it. But yeah, that's
we don't want that. We don't want to go back to that era.
Right. That's a big jump because you jump up 5.3 next year, and then everybody's going to demand some type of cost of living the following year.
Right.
So now you're putting yourself on a tough level. But most people agree that probably the amount has not adjusted high enough to keep up with inflation in the last few years. So this jump is sort of designed to maybe do a little
catch up. Yeah, because 1.3 as the COLA adjustment for this year, that's pretty low.
Right. That's not really accurate or in comparison to what inflation's really doing. Right. But again, Social Security doesn't want to make any. They commit themselves because they can never really go down. They can't say, you know what, we overestimated, so let's adjust it.
Right, that is very true. Once you get your benefit, it will not go down. Now, some people see their benefit go down, but that's based upon something totally different in that if they had higher level of income, they may be paying more for Medicare.
True.
And then that would reduce their Social Security benefit. But to your point, once you get your Social Security benefit, it's not going to go down. It's only going to go up based upon the COLA, unless you get hit with this Medicare additional cost, which applies if you're above a certain income limit. That can come into play.
Sure. I mean, Medicare is designed to help supplement your medical insurance. Once you've retired, you don't have insurance through your company. And so Social Security, one of their divisions is the Medicare portion where you have the Part A, the Part B, and the Part D if you choose to combine it all. And so they are paying part of your Part A, let you pay part of the Part B, but the amount that you make and things like that could have an effect and actually increase the portion that would come out of your pocket.
Right, and that income threshold that triggers additional cost of your Medicare Part B, it hasn't changed. It's not indexed to inflation. I think for a single person, it starts to kick in about $85,000. For a married couple, it's about $170,000. So those thresholds, more and more people see themselves getting tripped up along the way. So certainly something to kind of be aware of. But it's not a reduction in your Social Security. It's just the reality is they're asking you to pay more on your Medicare. So we talked about the cost of living adjustment. Obviously, that's one of the changes that happens every single year. You mentioned in the last segment the wage base, if you will, or the tax base that Social Security taxes apply. Last year was $137,700. 2021, it's up to $142,800. And I guess there's another thing that changes every year, and that has to deal with coverage credits. So what's that part about?
Correct. The way Social Security determines how you qualify is you have to have what they call 40 credits. Mm-hmm. And each credit is an amount of money that you make. You can only get 4 credits per year, although you could load up all your credits in the first quarter. But basically, every credit used to be, if you earn $1,140, there's 1 credit. They've moved that number up to $1,470. So you got to make a little bit more to earn the credit. You need 40 credits, which would equate to about 10 years of work. Doesn't have to be consecutive, so you could work a few years, not work. As long as you get to that 40 credit level, and now you have to make a little bit more to hit a credit, you qualify for Social Security. Now that would be a lower number compared to somebody that
work more, have more wage in order to have that credit
to qualify for the initial Social Security.
Kind of one of those things where they're making that adjustment to, again, have Social Security available for those that are working regularly versus kind of more on a sporadic basis.
Correct. Social Security, they want it to be a supplement. They hope that that's something that you're pairing up with your pension plan or your 401k or other investments you might have. But they do see the numbers that says, well, if 1 out of 4 Americans are using Social Security for 90% of their income,
It's an unbelievable
we got to work with that.
Yeah. Well, and speaking of that, I think people often think of Social Security as like a pension, but it's really not. I mean, there are some key differences between a pension versus Social Security. So what are some of those kind of traits of a pension and traits of Social Security?
Sure. So your pension plan is provided by your employer, and it's trying to give you a retirement plan based on how long you worked there, what your salary was, what your age is, and it can sometimes be a pretty good number. It can be strong, and so you have that. You can, when you retire from that company, you can start collecting it. You might retire in your 50s. It's available to you at that age, and it does offer you some income, and if you chose to have a payout for that continued past your death to your wife, you could pick that number. So you have some flexibility there. Where now Social Security is obviously provided by the government. We pay in as we go, so you're funding it yourself.
Right.
Social Security has some rules. It says the earliest you can retire is age 62. And again, I think they'll probably bump that up. That's just my own personal opinion to try to save out. But
sure.
and then once you lock it in, that's your number. But Social Security also can provide spousal benefits, so the amount that you're getting from Social Security will affect that.
So definitely some key differences between kind of your pension versus your Social Security. Pension typically employer provided. Social Security, well, some of it's employer provided, but you're certainly paying into that along the way. It's a social program meant to enhance those other types of income that you would expect in retirement. The expression of a three-legged stool, I guess, was one of the expressions that was used back when Social Security first started to talk about Social Security being one leg, pension the other, investments the other. Unfortunately, in today's world, there's less pensions out there, so people are having to beef up the investment side of that of that stool along the way. There's also some other things that I guess are certainly unique. Typically, Social Security, there's no option for a lump sum. Sometimes pensions will give you an option for a lump sum that you can then roll over. And then, there's certainly a difference in terms of survivor benefits. Social Security automatically provides those. Typically with a pension, you'd have to sort of elect that option. And then there's also a difference in the taxation as well of a pension versus Social Security.
Sure. Pension plan is a retirement plan, and so it's considered to have been deferred. So when you pull it out, it's 100% taxable. Everything you haven't paid taxes as you go along. Social Security, if all you collected was Social Security, you might not have to pay any taxes. And if you did have to pay a little bit of tax, no more than maybe 50% of just the Social Security.
Right, and the maximum amount would be 85. So you may find that your Social Security is either not taxable or only 85% of it is, versus a pension, which is no matter what, always going to be considered an ordinary income that you've got to report and pay taxes.
Correct.
So some interesting stuff. We're going to take a break. When we get back, we're going to continue the conversation with Rob Field, our resident Social Security expert at Nelson Financial Planning, here on Dollars and Cents. Welcome back to the program. Having a detailed conversation about Social Security on the program today. We're joined by one of our certified financial fiduciaries at Nelson Financial Planning. Rob Field is a national Social Security advisor. If you've missed any part of the show, we encourage you to check out our podcast channel or our YouTube channel. Simply look for Nelson Financial Planning, or go to our website, nelsonfinancialplanning.com. Upper right-hand corner, there's a bunch of icons. Click on the one that looks most familiar to you, and you'll be immediately connected to our channel on your favorite social media or podcast platform of choice. We've just barely scratched the surface. In this last segment, I want to spend some time talking with you about some spousal benefits and want to sort of some of the key considerations when applying, because I think this area is an area of a lot of confusion because there's been a lot of changes in this area over the past few years.
Very much so. The thing that is important to realize with Social Security, first of all, is that when you decide what benefits you're going to take, as in what age you start collecting, you lock in that number. That number affects benefits that a spouse would also get.
Right.
So a standard spousal benefit would be somebody is collecting Social Security, a spouse could get themselves 50% of what the spouse is earning without reducing the spousal portion.
Now, do they have to have all of their work quarters in for that, or is that just an automatic? That's just an automatic benefit that they get as a part of the spousal benefit.
Right. If the primary earner has filed, that's always the first thing. If somebody hasn't filed, you can't collect the benefit on them. So, then the question always becomes: the longer I wait, maybe the higher my benefit. But then the longer I wait, that's the longer before a spouse could collect. But you want to keep in mind that if you wait a little longer and your benefit is higher, 50% of that benefit would be larger.
Right.
But your question is important, the fact that the spouse who's collecting doesn't have to have worked. So as long as they're above age 62, they can start collecting the 50% of what the spouse is earning.
Pretty significant distinction. And I think a lot of people think, oh, I didn't work, so I'm not eligible. But the reality is that if they're married, they can collect under their spouse's record.
Correct.
And it doesn't affect how much their spouse gets. It's a completely independent amount that does not impact how much their spouse is collecting.
Correct. You would have the one spouse is earning 100% of whatever they decided to take. The second spouse is earning 50%. They both get that amount combined.
But to your point, the higher wage earner over the work history, and it's 35 years of work history that they look at, and they
Correct.
average out over 35 years. So the higher wage earner would be the one that would file first, and you can't claim the spousal benefit until the other one actually files and starts to collect, because there used to be a strategy that would allow someone to file and then suspend.
Correct.
Which I think a lot of people still think is perhaps maybe out there, but it's not.
It's off the table completely.
There's no way you can get it, and that was a few years ago. I think back in 2016. Is that
The
correct?
last time that you could do that, correct.
Yeah. So again, rules change, and if you forget that they change, or a handful of years goes by. The reality is that if you're going to collect on your spousal benefit, then the spouse that you're collecting on has got to file, and they've got to start collecting.
Correct.
There's no opportunity to say, okay, I'm going to stop it and start it later on. So, which was pretty powerful when that option existed.
Sure.
A lot of people were able to take advantage of it. And of course, the program, in order to shore up its finances, tries to eliminate loopholes like that. And that's a big one that they finally got around to eliminating back in 2016.
Right.
So really, when I apply, it's important to not just look at my record, but also my spouse's record.
Correct. Because once you apply, then you start the process. There's no saying, oops, I could have done this better. You've kind of locked it in. So keep it in mind when you take your benefit, what that amount would be, and then 50% of that is what the spouse is going to get. And then again, if the spouse is under for retirement age and they're collecting, then that number is discounted even more. So a lot of people are like, well, I'm going to start collecting benefits at 62, and then my spouse will start getting 50% of that. That's 25% or more less than what you would have gotten at full retirement age, and then another discount because the spouse is also taking it early. So you want to run the numbers before you just plug it in. 'Cause
Sure.
You can reduce what you think would be your monthly income dramatically.
Well, and that spousal benefit doesn't last forever, right? It
Correct.
ends, and it ends when somebody passes away in
Right.
that couple.
Right. While both are alive, you got that advantage of the primary getting 100% and the spouse getting the 50. One passes, like you said, doesn't last forever. Now, you've lost this one, but then the spousal benefit, instead of being 50%, is now a survivor's benefit. It's 100% of what he was collecting. But that's still a little bit less than what the total had been.
Sure, the surviving spouse that was collecting sort of the spousal benefit would then see their benefit sort of get grossed up to that higher number. So in essence, they wind up sort of collecting pieces of two different benefits, for lack of a better
Right,
description.
they call it a spousal boost. Whatever you qualified for, and then what you get with the spousal addition, they'll boost it up to that number.
Well, yeah, so there's certainly some strategy. When you think about spousal benefits, and that's kind of what we're focusing on this segment. When you think about spousal benefits, there's definitely a couple of strategies to really be focused on. And the first one, I guess, is having the lower wage spouse apply potentially on their own record, and then later when the higher wage spouse applies, then they can shift over to spousal. That option is still available.
Correct. The Social Security always does what they call deemed filing, which is every time you file or there's a change, they find out what's the larger number. So if somebody passes, they know that you're going to get the larger number. If you applied and then the other person has not applied for Social Security yet, so that doesn't come into play, you're taking your monthly from Social Security based on your own earnings. And then the second person applies, if their income would be more than double what you're getting, then you would be boosted up to theirs.
And the important thing is that you still have a strategy to kind of think about if your spouse is still working, doesn't want to collect, and you could collect under your own record. Now, in that case, you'd have to have the quarters. You've got to have your 40 quarters in to have your own record to apply independently.
Correct.
So that is a little different. But there's definitely a strategy that would say, okay, maybe I apply, even though my husband might be waiting, or my spouse might be waiting, I apply, and then I might be able to get some additional income. And then the other strategy, which I think you've talked about, is thinking through, does the higher wage spouse wait to apply to make sure that there's a bigger benefit when one of them passes away?
Correct. Longer you wait, the larger the monthly benefit. So if you have a way of putting that off, that other income can be generated from different sources, then never hurts. Try to get a little bit more per month.
That's exactly right. So it's important to really think about Social Security and try and integrate it in with what the rest of the picture looks like, right?
Correct.
I mean, there's not a one size fits all or you must do this in every set of circumstance. It always depends upon sort of an individualized analysis. Here's the reality, though. We're out of time on this segment of our show. So I'm going to ask if you can join us next week. It's Labor Day weekend. So I want to ask if you can join us next week, because we got a couple of things that we have not talked about, particularly the whole should I stay or should I go conversation, right? Should I apply early? Should I wait? We talked a little bit about some of that stuff, but we certainly want to dig more into that. And then I think it's important that folks know, okay, how do I get this information? Because they don't send it to you in the mail anymore. And so there's a particular process that you've got to go through, and then some things to think about in terms of how you integrate that with the rest of the plan. So we're going to wrap it up and get on out of here. Enjoy the rest of your Sunday. We're going to be back next week to sort of continue this conversation about Social Security. Rob, thanks for joining us on the program this week.
It's been great. A lot of fun. Looking forward to the next one.
Thank you very much. With that, we'll sign on out. Dollars and Cents with Joel Garris of Nelson Financial Planning.